There we go. Test one, two, three. Test one, two, three. There we are. Okay. Hey everyone. Hope you guys are all having a good day here today. Loki says hello. You can see his little tail wagging back here. He wants some type of treat here, so we'll get started off with that. But this is the FOMC stream. Earlier this morning with the CPI stream. Things looking pretty darn good. Hello. Excuse me. There you go. Good boy. Right now, it's more about what Jerome Powell says as far as a rate cut. We'll be talking about that versus a rate hike versus staying higher for longer, which is most likely the case here. Excuse me. And then afterwards, make sure I'm not running over his feet. Afterwards, we're going to listen to his press conference here and kind of see where things go. I think at this moment in time, things are working out pretty well for us. The market's doing well. We're going to be checking out the charts here. Everything is primed right now for Bitcoin to break to all-time highs sometime next week or even this week if we're lucky. Most likely than not, unless we had some really bad news, it should be happening sometime this month. Like, I'm about 80 to 85% sure it's going to happen this month. So I think everybody's really excited. Things are getting a little bit more spicier here. Hey, Crypto Ricky, happy to see you. Jay Cena, excuse me. Let's see. And hey, Crypto Ricky, what do you call? I scared for FOMC. Oh yeah. Oh, I bought the dip. I put out videos every time I buy the dip. Ow, ow, fuck. Ow, motherfucker. Ow, damn. What the fuck was that? Oh, I forgot. I have so much tech by me that sometimes all this random crap hits me. My nail's fine. All right, but anyway, the pain will subside. Yeah, I bought the dip a few days ago, but I didn't get the very last dip as far as like at the very, very bottom. I kind of bought it when Bitcoin was kind of stabilizing at those support levels. That's when I bought. So I do own quite a bit off of these last few dips. I didn't buy as much as I would have just because of the CPI data plus FOMC. I was kind of a little bit more iffy about what could possibly happen here. So at this point in time, I do have quite a few longs. They're much more short-term type of plays, though. They're not swing trades because you guys know how I feel about these types of things. It's just not a swing trader's market to me. If I were to buy the Bitcoin right now and go for a swing trade, I'm just going to wait for this breakout first, and I'm going to take full advantage of that swing that we've been talking about as far as that with like $3 billion of shorts ready to be liquidated at 72 billion, and then like 12 billion ready to be liquidated at 74 billion. There's a huge short squeeze that's going to be coming in here pretty soon, hopefully propelled by the Wall Street, ETF markets, etc., and that's going to be a very, very big thing. I don't know exactly when the Ethereum ETF news is going to be coming out, but I think it's we already know what's going to be happening here. We already kind of have an idea that they're not going to be cutting rates. They're not going to be raising rates. Of course, they're probably just going to be going on and saying, hey, we're going to be keeping it higher for longer. Here, let me sort of poll for you guys. Are we getting a cut, a hike, or a hold? Yeah, hold. I think that's probably the best way to say it, right? Hold, cut, and a hike right here. And let me put a little bit of a comma there just to make sure my brain realizes what's going on. Maybe that'll work. There we go. Started a poll for you guys to vote. Now let's get over here to the charts very fast. I've had a pretty shitty morning. What do you call it? I was up in bed and I was laying down charging up my phone. And then all of a sudden I felt something warm on my leg and Loki had puked on me. I don't know what he got into. I think he got into some cat food or something and he just puked it up on my leg. And I was just like, washed my leg off, took all of my blankets in my bed and I tossed it into the washing machine. Now they're on like an extra heavy duty hot water, double soap, double rinse, heavy cycle thing. So it's been a rough morning, guys. And then Loki attacked a poor squirrel family. It was tragic. So a lot of stuff going on in the morning today, guys. A lot of stuff going on in the morning here. So a couple things here. I do have CNBC ready in the corner right here so you guys can see it. Let me move it down right there. Is that? No, that's not it. There you go. Let me just tick this up a little bit here. Tick, 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 tick. There we go. And so when Jerome Powell does talk, we'll have him here. I may just make it full screen so we can talk, but I kind of also want to show you guys the charts and stuff behind it. So I want to have like a live reaction of the market and at the same time him speaking. So we'll have to plan that out as well, I'll take a random guess when the time comes here. But anyway, things are looking very, very good. As far as the weekly chart right now, which has been kind of ugly over the past few days, you have to admit, we're almost back to being positive. In fact, like a few minutes ago, we were positive here. So, worst case scenario, we have a double top. Best case scenario with some FOMC, some good CPI. We're looking at a move that takes us above 72,000, above 74, causes a short squeeze, and it really propels us back up towards, let's say around like $80,000 is that next level of resistance that I really see. I don't think it's going to be difficult for Bitcoin to really go much higher. Once we break out here, consolidate for a little bit, just to make that new support level hold, and then boom, off to the moon here. So let me show you some things here. Weekly chart, still not into that nice little buying opportunity. I know. It's getting there. It really is getting there. And you guys can see there was some bearish activity right here. And then this doesn't really get you to buy at the bottom. This is why we've been dollar cost averaging. This gets you to buy the pump, in which case you're very, very happy, right? In this case, there was another pump right here. You buy that pump, everything's green. You're very, very, very happy. Pump. Breakout, very, very, very happy. Maybe. That's kind of the goal I'm going for here right now. So it's going to be a little bit of a process. We're not there yet, but I think by waiting for that point, you really don't have to have that butterfly in the stomach mentality of like, oh man, is this trade really going to work out? With this, I'm like, oh yeah, it's going to work out pretty well. We can kind of ride this wave. It may take a few weeks to get there. Don't get me wrong. It's not like it's an easy ride. You guys remember the volatility with all this? You guys buy right there? There was some volatility, some nastiness over here before we reach the promised land. And of course, volatility. I always wonder what would have happened if we were right here and we didn't have that bad CPI report. Where would Bitcoin have gone? I think there's a chance to say Bitcoin might have actually gone up to like $75,000, $80,000. But that was not the case for us because we had a bad inflation report here. So, long story short, things are looking pretty good. You guys see us battling a level of resistance right now. We managed to break out above the 50 moving average on that 4-hour chart here. That was something that I was not expecting. I thought we might actually have some issues with it. We got knocked back down, but I would say things overall still looking good. This 15-minute chart, it looks like we're trying to pull back a little bit here. So, be careful if you're trying to long and aim for the heavens and stuff like that. I'm kind of just patiently waiting for this FOMC announcement, in which case we're not going to hear anything new. I believe we're going to have a hold. We're not going to have a cut or a hike. I think all of those are off the table. Personally, that's my opinion here. Then going forward, I think during the press conference, he is going to be pretty darn dovish. That dovishness is really where I think Bitcoin has an opportunity to pop a little bit. Normally when this stuff happens, we can have a pretty good move off of it. I'm still expecting maybe some consolidation going forward. So all I'm doing right now, as you guys know, if you guys have been watching the previous few videos, is I'm just going to continue to dollar cost average and buy up some of these tokens that have had some really big dips. If Bitcoin continues to ride higher, excuse me, I'll be happy with that. I'll be ready to go. But, I think right now the best thing for me to do is just dollar cost average because it's typically been working so far. Bitcoin is definitely more sideways at this point, still working out okay. Altcoins, I hate to be repetitive about this stuff, but altcoins are much more oversold. I want to buy some altcoins here, and I want to be happy to do so. This is all the way back in March when we had that bad CPI report. We're still down pretty low. I'm buying some Ethereum. I'm buying some Solana here. Solana hit that support level that we've been talking about. Barely. Wow. Just barely right there. Barely. And then bounced right back up here. Dogecoin hit support levels, bounced off of that. WIF hit support levels. Bonk hits, Bonk did not hit support levels. Interesting. Bonk managed to hold a little bit better than most. Miro hit support levels. Baby Doge hit a support level here. How's Shiba Inu doing right now? This one's definitely been a grinder. It had a momentum and it just kind of lost all of it more recently. But again, a lot of these tokens hit their next level of support. They're bouncing off of it. I still think it's an okay time to be dollar cost averaging. I am not in the mood to do a lot of swing trading still. I'll let you guys know when that time comes upon us. I still think at this point in time, it's going to be kind of iffy here. I really want to have confidence before I open up a swing trade because then, if it doesn't go my way, I'm probably going to lose like $10,000, $15,000, and that's not something I want to do. If it go once I have that confidence, then I'm like, oh yeah, I'm willing to lose that $10,000, $5,000, whatever it may be, $15,000, because I'm so confident Bitcoin is going to go higher. I just want that confidence. That's all I'm looking for here. Pepe, Still going higher. Beautiful. Didn't really run into much support though. I mean, this old level of support, but that wasn't yesterday, you know. Or I guess, yeah, you could say yesterday a little bit here. Yeah, you could actually say that. So remember to look at those support levels here. It makes a big difference. R and DR, it doesn't even look like it right now, but it's up 14% today. GRT's up 10%. They all have a long way to go, and I think dollar cost averaging is probably going to be the best way to approach a lot of these here. Going over here to coinmarketcap.com, and we got about 7 minutes until this announcement comes out, so pretty soon, just so you guys know, I will be popping up a good CNBC, and we're going to actually kind of keep track of everything going on there, all right? So Bitcoin's up around 4 or 5% today. Ethereum's up. Everything's up. Is there anything up? Actually, any more than anything else? Live Peer is up 27%. I'm guessing this just broke out into the top 100 actually today. Injective is up 23%. Notcoin is up 21%. Whoa, that's a big one right there. Pendle's up 15%. Stacks is up 15%. Uniswap is up 14%. I bet the secondary markets, all the shit coins, are going absolutely berserk right now. So just keep in mind, this is a day trader's market. Might not be a swing trader's market, but if you guys want to hold for 24 hours to about 30 hours, I think that might be a golden opportunity for a lot of you guys out there. You're going to be waiting for consolidations. You're going to be waiting for news announcements like this. And then from there, really just pile home everything going on. Because again, let me open this up for you guys very fast. Let me do a little bit of a zoom in at 200%. Bitcoin shorts are piling up where there's no long leverage. A good inflation data and a dovish Powell could be explosive. We got the good inflation data. Now we need a dovish Powell. Dovish Powell is pretty darn common these days. Remember last time during the FOMC meeting, I think there was actually, I had that one for you before. FOMC is usually great days for Bitcoin. And I mean very, very, very good days for Bitcoin here. Let me go to Ben. And there it goes. My favorite chart from Ben right now. You see how CPI has been rough March and April? Well, guess what? Back in May, good. June, another good one. But every single time so far, FOMC has been a great boost to the market here ever since we started to consolidate here. So I don't think things are going to change right now. I do believe that FOMC is going to give us some really good data, some really good information, and people are going to be very excited about this. That should propel Bitcoin to go to those nice highs here. Again, am I buying and loading up in preparation for that? Dollar cost averaging, yes. Swing trading, no. If you guys do want to make some trades here today, at this point in time, what you guys are hoping for here is to buy around this point if you haven't bought already. If you didn't buy at the dip, I don't know. At this point, you're definitely going to have that stop loss way down here at $66,000 basically, and then ride the wave and then see what happens over the next few days. Generally speaking, you're still in a good sense, but you can see right here, bearish, bearish, bearish. Not the best way to be going along, even if you have a really crazy wick right here. Like over here, that worked out okay. You can see how sometimes it can kind of get dropped back down before taking off. Those shorts, I mean, they know how to get you out before making you chase it back up. It's happened a few times. Nice long thing. Crazy wick right below the support, attacking those stop losses, and then going higher. Happens way too much in my opinion, which is why I'm always kind of like, hey, if you just wait for the weekly chart to be good on your side, then you don't have to worry about stuff like that. But if you guys are going to swing trade, be very, very cautious about anything you do, because there are like very smart people that know how to attack that stop loss, take you out, make you lose money, and then boom, the assets go into the moon, and you're just sitting there like, what the fuck? You're kind of stuck. And I only say that because it's happened to me, okay? I only say that because it's happened to me. It can be a nightmare, guys. It can definitely be a nightmare. But hey, Bitcoin's still finding some momentum here. I thought we were going to break down below this little moving average here, or one of the two, a few minutes ago. But we're actually still popping off here, so that's good news right there. We'll see if we can break out. There is $70,000 right here, just so you guys can see. There we are. 70,000. That's kind of that wall that you're looking at. I had this on another chart, but I guess it's not on here right now. Let's move this down a little bit here so you guys can keep track of that. And then I want to see if anything's actually moving a little bit more here. GameStop, I just wanted to see if this has been doing anything. GameStop's not doing anything. My FFIE not doing anything. I managed to buy 3 options because there's not much liquidity, but I'll let you guys know how those are doing pretty soon. Turbo still doing a whole bunch of nothing after having an abysmal last few days. I mean, just look at that spike and drop. Mog, still going over here. Still coming down after a really nice move. RLC, one of my favorites. Horrible, horrible week. So altcoins have a lot of room to make up here. A lot of room. So let me get this ready for the stream here for Jerome Powell. Because basically we're going to get an announcement. We'll talk about that announcement a little bit, but then, it goes quiet for a little bit of time. The CNBC people talk, and then from there, once Jerome Powell comes out again, then I'll be able to put him up on there for you guys to see what's going on. So before we go any further, make sure to hit that like button, subscribe. I appreciate you guys a lot for joining me here today. It's definitely been an exciting day. Oddly enough, when Bitcoin broke out earlier today off of this news, that Bitcoin wasn't even the most surprising thing to me, as far as exciting. It was how crazy the dollar index was going at that time. Look at this. It just dumped and dumped and dumped. It's trying to have some type of reversal right now. It's trying to. And this usually happens around the FOMC, not so much of the CPI data part. However, I mean, this was chaos because, as you guys may or may not have known, we popped off a few days ago based off of that really bad jobs report, which was actually good, but because wages had risen so much more than expected, around 4%, that was causing a lot of if wages go up, that means goods have to go up along with it, which leads to higher inflation, which leads to less rate cuts in the future, which leads to higher for longer, which is bad for the market, which means we should sell, not buy. That whole thought process was going through people's heads, and you just saw a spike right up here. Plus, on top of that, we had some European elections that saw people from the conservative side get more seats than expected, and that freaked out the markets as well because it was a surprise, I guess. There was a bunch of stuff going on here. However, you can see how one good CPI report can just bring this down by a lot. So what I'm going to do right now is CNBC is
expected and raising hopes that the Fed might.
CNBC is on. Let me turn down my volume because holy shit, that was loud in my ears. And let's go
see, or as many as 2 rate cuts this year, I should say, and, after that release.
Fed decision is imminent.
All right, let's get right to our all-star panel as we are just minutes away, as we mentioned, about 2 minutes away from the Fed decision. We've got Kristen Bitterly of City Wealth, David Kelly of JP Morgan Asset Management, Michael Kushma of Morgan Stanley Asset Management. Let's go around the horn quickly. Michael, what are you expecting the Fed to do? I can anticipate. And what do you expect it to say?
Well, I expect them to make no changes in terms of the interest rate strategy, but talk about inflation is now doing a little better than it was before. They had highlighted last month that inflation was disappointing. Probably take that out and not comment on disappointing, but that we're making progress, but not enough progress going forward, and that we're still on track for rate cuts at some point later this year.
But you think that it opens the door a little bit, but you're skeptical that there will be a rate cut this year. Am I correct?
I'm skeptical there'll be more than one, but I will be the first to admit that today's inflation data was quite shockingly low. Maybe it's just a correction from the excessive numbers maybe we saw earlier this year. But if we average them out, inflation is still reasonably perky, although still coming down on a year-on-year basis. There's a stalling out of inflation, which would suggest a go slow attitude with regard to rate cuts.
Kristen, what do you think? And I'm tickled by that reasonably perky characterization.
So I would agree in terms of inflation. It gave a little bit of relief this morning. And I'm looking for, particularly within the statement as well as the conference, more information about the employment backdrop, because we did get conflicting signals, whether you were looking at non-farm payrolls or whether.
So this is like a little bit of a lag here, which will be a lag in even getting to you. But basically right now it is a hold. Nothing is changing. You saw the dip off of that news. Relatively speaking, that's okay. What really should get us going is Jerome Powell's speech. Jerome Powell is usually the best thing for us right now because he is very, very dovish. We'll hear the announcement from them in a second. I will be playing it live, but the tick, 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 talk that they do. It's like they say so much without saying saying so little. So right now, I still think this is overall very, very good news. Well, okay, we're actually getting a little bit of a pump here. This is interesting. I don't want to say this a pump, but like a lack of a drop. The 1 minute chart here is showing you some stuff. The 1 second chart right here is just showing a pretty big move. And there we go. Now I can actually play that sound for you.
June meeting leaving interest rates unchanged and continues to say that it won't be appropriate to cut interest rates until it's gained confidence that it's headed towards its 2% target. The Fed on average now projecting 1 rate cut this year, down from 3 in the March forecast. 4 officials, in fact, are projecting no cuts this year, up from only 2 in March. One official actually says no cuts this year or next year, no cuts for you. They are projecting 5 cuts through 2025, which is down only 1. So they kind of get it done over the same period of time. Just the near-term cutting is much less. And I'll get back to that in a second. On average, they projected higher Fed funds rates this year and next. And, of course, interestingly, in the long run, the neutral or long run rate now up another 0.2 now to 2.8 from 2.6%. They only accounted for the recent progress with this morning's low inflation, by the way, along with the good numbers in April, saying there has been modest further progress towards the Fed's 2% target on inflation. They had noted a lack of further progress in the March report. GDP outlook unchanged at 2.1% this year, 2% next year. The Fed saying economic activity continues to expand at a modest pace, same language it used in the May statement. Unemployment rate forecast was unchanged at 4% this year,
not bad.
A tick higher for next year than had previously been forecast at 4.1%. That's, of course, interesting because we're already at 4%. They did say in the statement unemployment is low and the job market is strong. Core PCE, interesting here, too. The average for officials now is at 2.8%, up 0.2, even though the street estimates after this morning's report are that it will come in at 2.6% this month. So they're projecting, in fact, a degradation or a decline or an increase in inflation this year on the core. In fact, only 3 words were changed in this policy statement when it came to the economy.
I feel like they got caught flat-footed over the past few months. Now they're adjusting when they should have never adjusted in the first place. Now they're like, oh shit, whiplash.
All right, we'll tell you this, and you can write this down at home if you're playing. There were 10 officials in the March projections at 4.625 or below in March. Now not a single one is there. They're all above 4.875 for this year. So it feels like either they ignored the progress on inflation this month or last, or there was some kind of a coup of the hawks in the Fed committee room this meeting.
All right, Steve, stick around and let's get back to our panel for some reaction here. Let me begin with you, David, if I might. Is the market likely to like what it's just hearing?
No, it won't. I think the market will have been responding to better news and inflation this morning. But of course,
all right. So yeah, I share the same thoughts here a little bit. I think the Fed was really freaking out over the last few months of bad inflation to the point where they had to adjust. And right when they adjusted, the inflation was like, oh no, we're chill, we're good. And now the Fed is going to have to whiplash again. And so I'm very interested to see what happens to Jerome Powell in this speech. It is going to be very, very important. I do think the fact that they are so much more bearish or more hawkish as far as how inflation is going to pan out, that is a bearish sign in the short term, which is why, again, we have to listen to what Jerome Powell says. That was kind of a shock about how much they got hawkish or how much they think inflation is going to go up. So that's going to be the surprise here. How much they think it's going to go up when in reality, after today's report, everything kind of flipped on its head. The Fed is trying to help make everybody happy, and now nobody's going to have any respect for them, or that respect is just kind of eroded even more and even more and even more. They didn't stick to their guns, and now you can see the price for that. So, we'll keep track of that as well. Let me actually move this over here. Forgot to put my subscriber list back on here from the other stream. If you guys like it, please make sure to subscribe, hit the like button, comment. Does a good job here. And again, we're still finding a way to hold support here. It's kind of a craziness if you ask me. Like, I am not trying to trade this right now, hence why I said be very, very careful if you're doing anything. But man, look at this. This is the second chart right here. That's why I pay so much money for this crap. What do you call it? Massive move down, huge pop back up, and then we're just kind of settling back down, consolidating, and we haven't broken down below this short-term level of support. So what I'll do for us very fast, just to show you what's going on, that's our new support level right now, 68,800. That's the level we're trying not to break down about below. So give it a few more minutes. Jerome Powell is going to be coming out. We will listen to the Almighty speak, so Almighty Fed Chair speak, and then he'll move the market up or down, and then we're going to go into like a boring phase for a few hours. After that said, later on tonight, going into tomorrow, we are going to see much more of an aggressive play. We'll have to see if that's a bullish play or a bearish one. I'm thinking more bullish over the next few days here going into weeks, but we are going to have to settle down for a short amount of time here. And there you go, still pushing us down a little bit. Let's see if we actually get pushed down below the support. Because if that happens, then we're most likely going to be giving up some of the gains from that CPI report we had earlier this morning. Holy wick, definitely so. Crazy how 1-to-1 Bitcoin moved with the news today. I mean, everybody was I don't think many people were anticipating a lower than expected inflation rate. I think people were pricing in that 3.4. I don't think many people, maybe they thought it was going to be a 3.5 based on all the bad news we've had over the past couple quarters, but came in really cool, 3.3. Everybody's very, very happy. In part, this was actually, so what happened this time was energy prices came down a little bit, and that kind of cooled off everything. And one of the reasons energy prices came down was kind of an artificial reason. And I think maybe that's what the Fed might be, if you really ask them what their thought process is, that this may be it. So over the past month, Biden, you know how he likes to drop the oil reserves, so he'll inject a national emergency oil reserves into the economy, thereby lowering the price because you flood the system with supply. The demand is still the same, so the price goes lower. But your basic economics. So when you do that and oil prices start to come down, everything becomes a little bit cheaper down the way. Now, as soon as you stop doing that, prices maybe bounce back up a little bit. And I think that's maybe where the Fed might be saying, hey, there are some things wrong here. We still see some issues going forward. And I think maybe they're putting that into consideration. They might not be saying it because, of course, this is an election year, guys. Jerome Powell is extremely political. He understands the political landscape. If you're at the head of a bureaucracy, you understand how to play the political game. You understand it, you understand it, you understand it. And at this point, Jerome Powell is more friendly with Joe Biden than he is with Donald Trump. Donald Trump, I think, has said, I'm going to fire you. So I think he definitely would want Biden to remain in office so he can keep his job, of course. So as we kind of hover around the support level here, let's go over to this other chart and let me show you oil very fast so you have a better understanding. So this is the weekly chart. You see how oil has been coming down quite a bit? It really took a spike last week. Remember, we had good job supports and everything. That should be a good booster for the economy. Emptying some of those reserves, it really does have an effect. And, you see what happens after we stop. Prices typically just start bouncing back higher. Not the end of the world here. You guys all know what the gas prices are around you. They're much more expensive than the last few years, but it's not like it's gone up a lot maybe over the last few months, depending on where you are. And Seattle could be a lot different than where I live in, around Tacoma area, which could be very different than Houston, which could be very different than New York and Illinois, all that type of stuff, right? But yeah. So we'll keep track of all that stuff right now. So let me get off of Benjamin. Actually, let me get off the shorts here because, again, we are just looking to smash through that $72,000 mark and looking to smash through that $74,000. $12 billion in shorts up to $74,000. Come on, who doesn't want to have that squeeze? I'll tell you what. And hey, I'm happy to see my man. The unexpected was unexpected. There you go. Nothing is expected. What do you call it? It's the consensus. I think that's what the Wall Streeters call it, the consensus. So let me go over here very fast and let me search for FOMC. Let's just go to FOMC. Benjamin, the dot plot shows the outlook for various FOMC minutes. 0 rate cuts this year, 4 members. 1 rate cut this year, 7 members. 2 rate cuts this year, 8 members. Okay, so it looks like we're probably going to have 8 people right now that say 2. I think 2 is probably going to be the best chance for us to have a rate cut here today. I think we're going to have 2. And the reason because of that is I think inflation will continue to be okay. Not great, but just okay. And 1 or 2 more months of okay inflation, I think moves a couple of those members right here in the middle. I think that moves them over to 2 rate cuts. I'm not saying 3, 4, 5 or anything crazy like that. But I do think that somewhere along 2 rate cuts is perfectly acceptable here. This isn't 2024, 2025, 2026, and the longer run here. Now, there are some people that say 0 this year. I don't think so. I think it's definitely going to have to happen sometime in September. And if it doesn't happen in September because data is not good, I would say then it's going to happen in November. I really don't think, unless we have something really crazy happening, that we're going to have that type of cut, And again, we'll have to wait to see how this pans out here. Let me go over here a little bit more very fast. Anything new here? Oh, this is a fake Jerome Powell thing. I love when they do those, but the language is always questionable. Jerome Powell, this is hilarious. Oh yeah, we're seeing a lot more of these memes popping up here, but basically everybody's getting hyped. But he's not hyping anybody up. We're all kind of like, what the fuck, dude? We wanted to cut today. Breaking FOMC no cut. Cuts push back. Expecting an increase in the PCE core rate. Wow, very hawkish statements. Hence why Bitcoin is looking like this. And again, we're still holding here. I mean, barely, but we are holding. It's going to try to do a little bit of a ricochet, but we need to, from a technical perspective, we need to find a way to get back above this right here, 69,427. Let's listen to Centelli.
Open the chart up to Jobs Friday. You can see it's holding right and coming into that zone. Look at a 10-year. 10-year was right around 4.25, so it's up about 3 basis points. Look at where it's at based on Friday's jobs report. And finally, the dollar index. Subtle improvement. And once again, you can see where it's based on the big moves from Friday's jobs report. You know, if you look at what's going on with the Fed, let's be frank here. Okay, we get a cut or two. How much does that really change? We have a two-speed economy. We have those who have a need for credit and those who don't. And those who don't most likely have savings. Maybe they're baby boomers. Their income isn't going to suffer much with a cut or two. Is it going to help the housing market dramatically, a cut or two? Especially considering how elastic the relationship is with 10-year yields? I don't think it will. And in terms of financial conditions, when I talk to people and you say financial conditions, what's the first thing they talk about? The stock market. And where are stock market prices? We all know where they're at. I think you'd have a hard time saying financial conditions are too tight. I think a rate cut or two isn't going to make a huge difference. And the issue is inflation. The year-over-year number today is still higher than it was in January. It was 3.1. So ultimately, inflation's coming down, but it isn't going to change the middle class's problem, which is the compounding of inflation over the last handful of years, and those prices aren't going down. And even if they stop here like auto insurance, do you really think it's going to go dramatically lower in the future? I don't. Kelly, back to you.
I know. I don't think many of us are expecting a break. Rick, thank you very much.
I know. Whenever he gets into one of those rants, I can't help but laugh because he's so funny about how he talks about it. Because, you know, you could talk about the economy, but then he like brings the middle class to it, and he's always like, "Yeah, regular people, they see through the bullshit. It's still bad. Everybody knows prices are higher. We have to figure that shit out." Okay, let me hide this while they go into a commercial very fast. There we go, and we'll come back to it in a second as Bitcoin tries to hold up here. And it looks like we are rebounding quite well after that little drop here, so that's actually some good news there. Nothing's gonna happen. It'll be a giant waste of time like most of these meetings. Let me go back over here to that Benjamin thing right here. So this is what typically happens post CPI and FOMC meetings so far this year, since March. So this is like, you know, after we kind of hit that high point, we had that first bad batch of CPI data. This is kind of what happens here. So you see CPI, after we had bad CPI, the market found its way back down. After a good FOMC, the market found its way back up, and then down, and then up even more here. And that's kind of what's happening. So I would anticipate still to have some type of move after this. I wouldn't say nothing is going to happen, but, you know, as far as it happening while he's talking, that's just your typical fun volatility that you can day trade. It's not going to be the big move that we're expecting that usually takes days to develop. I would agree with you there. It's not going to be some type of 20% pop off of Bitcoin. Wouldn't that be fun, though? That'd be fun. Price discovery? Depends on what you mean by price discovery right now. I mean, we're at it. We found our levels of support. We know our resistance. Right now, it's mostly news driving this market. It's not so much technicals at this point. But November is election month, right? What can they cut in September to... I can't read what's behind the heart. To help the election? They can, but I don't know if Jerome Powell will. I think Jerome Powell wants to find a way to cut. He wants to find a way to cut. But if you look at the data, it's still very hard at this time to say we are going to cut. I could, in theory, see him being much more willing to cut and people believing he has the will to cut in September. If he were to cut before September, oh man, that would just lead to a whole bunch of chaos as far as, you know, is the Fed really doing the job for the Fed or for the government, or is he there to help out, you know, Joe Biden? It would lead to a very big shitstorm, which would really erode a lot of the credibility of the Federal Reserve, which would not be what you want to see. Remember, guys, this guy's already had a horrible reputation. We all have short-term memories. I understand that. In America, we are on our phones a lot. But if you guys recall, this guy lied to us for like a whole year and a half saying this was transitory inflation. And inflation was to come back down and be very, very easy for that to happen. And that's before he even wanted to raise hikes, raise rates. So his reputation as far as like maybe people of my generation, or maybe other generations out there, I don't know what you guys tell me. Like, do you think Jerome Powell has done a very, very good job, a very, very bad job, or he's, been dealt a bad hand and he's done a good job, or he's been dealt a bad hand and he just hasn't risen at the moment? There's a whole bunch of different ways you could describe what he's had to do, because part of it has been okay. Let's see right here.
Steady, and we're less than 15 minutes away from hearing from Fed Chair Powell, which can often be even more market moving. For more reaction, let's get to what investors should do now and to listen for.
There you go. Okay, there we go. So we got about 15 minutes left until he comes to talks. We'll be chilling out here for a while. Don't feel bad about that. But yeah, I'm pretty sure it's going to be September as far as I'm concerned here. He was pissed. Oh, but yeah, that's Rick Santilli. He's always pissed. He's always pissed about something. And I agree with him on a lot of points, actually. I'm in Washington here, so I'm much more of like we might call a Democratic stronghold. There are different Democrat views that I hold and Republican views that I hold, but I'm usually much more conservative on economic policy because of my income, me not wanting to pay as much taxes, basically. And, when the government fucks up and they don't spend my money correctly, I usually get irritated. I think if the bureaucracies were just efficient, or parts of the government were efficient, I'd be much more likely to give them more of my money, or not be as mad at them when they take my money, right? There's different ways to approach it. But yeah, Rick Santelli, he's always mad. He's always finding a way to be mad, which is, again, why I enjoy him. I like people that are kind of angry sometimes, as long as they're fighting for whatever they're talking about. It could be some guy in downtown Seattle, it could be some guy in Oregon, or versus some guy in Texas or whatever. I don't care. But as long as they're passionate about what they're talking about, I kind of vibe with it a little bit more, right? He's just a money printer. You know what? Jerome Powell, he does print a lot of money. That's why there's so many memes of him. I think he just wants to retire with a good name. I think he doesn't want it to be tainted. So if he were to cut rates too early and inflation spiked up for whatever reason, I do think his name would be tainted forever, and then people would make fun of him and talk behind his back for the rest of his life. So remember, guys, if we go over here to... There we go. Here's the Fed funds rate over the last 3 years. We all know it's been going up, and we've been kind of holding steady, Eddie, and we've been here. Eventually, this will start to tick down, and things will get a lot better for us. However, you go back to Max here, and you see how back over here in 1977, the 1980s and the early 80s, basically, late 70s, early 80s, you saw how this point in time happened where we rose rates, we cut too early, we had to get back on the horse again, and then ended up working out a little bit. We tried to go up and down, up and down, up and down. It is absolutely insane. However, I would say things were a little bit more simpler back then. Now it is definitely more complicated. However, the guy that did this, Volcker, he is still talked about and whispered about in Wall Street to this day. Even on CNBC, they talk about him all the time. He doesn't want to be remembered as a Volcker. He doesn't want to be remembered as that guy. That'd be horrible. And, when I talk to my future kids and whatnot about, Jerome Powell and stuff like this, I'm not going to say he was some great Federal Reserve chair as much as you talk about to your kids about this type of stuff. I'm going to say he was a pretty ineffective one, but I don't think he cares about my opinion. I think he cares what Wall Street talks about. Is he going to have the respect of a lot of people from Wall Street? Maybe. I don't know how Wall Street people think, right? I know some people on Wall Street, they don't like him at all, but they're more my age. They're not senior management that usually has the type of cachet and things of that nature. And hey, Black, happy to see my man. I swear everyone sucks off Jerome Powell like he's the new messiah. He does draw a lot of eyes, right? I think it's because everybody really is just trying to figure out what's going to happen with this market. And the last few times, again, going back to Ben, geez, this thing comes in handy so much. When he talks, the market has some really crazy moves along with it. So if you guys are looking to make money, which I'm sure we all are, based off of what he says now, a lot of you guys may be opening up some, 24 to 30 hour trades where you guys are holding just for a potential pop sometime later on tomorrow. You're going to sell, get out of it, take your money and run. Those type of moves here. Hopefully he's dovish here. As hawkish as that statement kind of was, I think as soon as he starts to answer some questions, he'll get back to that dovish stance that he's been in for a while, where he's saying, oh, we're not raising high rates right now. We're just going to be data dependent. We see things are going in the right direction. Possible this can happen. It's possible this can happen. And I think those will open up some doors for us here. Did I buy calls on GameStop? I did not. I bought some calls on FFIE. The GameStop calls are that implied volatility is stupidly high. You'd rather be day trading those options instead of trying to swing trade those options, because if GameStop does not go the right direction like every day, you will just see your options just plummet here. So you're looking for like a good 20, 40, 80% move off of GameStop to make a really big profit off of it. Right now with my, let's see. Let's see right here. Let me check. Webull. I don't even know where my Webull app is. There we are. I can tell you that I'm probably down on the trade. I'm down 17%. 17%? Or 7. So my days profit and loss is 7.15%. I'm sorry. So I'm down 7% holding these options. They're not doing so hot right now. One option is down 20%, one option is down 15%, and one option is down 7%. So all of them are down pretty bad. But they all kind of expire. One expires next week, one expires the week after that, one expires all the way in August. So I'm kind of okay with it. It's just kind of a YOLO where I toss in like $30 to see where it might go, and we'll see if any of them pop off. I make some money, I'll be happy with it. All it takes is for one to blow up, and I can turn $7 into a few hundred at least. So that's kind of the theory here. But again, it's such a gamble that I just toss in a few bucks just to have some fun with it. Maybe I'll buy some more tomorrow, or maybe by the end of today. I don't know. There's a few more hours left before trading stops. What, an hour and a half basically? We're getting close. But no calls on GameStop, that's for sure. J Powell already tainted. What difference does it make if he's tainted just a little bit more? It's because the way Wall Street works, and a lot of people kind of talk, it doesn't make much sense to the average guy. It's almost, think of that show Succession in a way, where everybody's kind of a little cuckoo, but in a good way, because they all kind of know what they're doing and they can all make money off of it in a way. He's already kind of tainted. He already has that bias. I totally get you. But there's always a fear that you go too far. And if you get excluded from those circles, you get excluded from those circles. Remember, Jerome Powell, he wants to retire off of the Fed, and then he wants to go do all of his speaking events. This guy's going to be making like $100,000 just to speak at some high school graduation. He's going to be making so much money. Don't mess with the money. Let's just kind of keep this steady, Eddie. And at this point, he just wants Wall Street to be happy with him. Biden, he wants to be happy as well. Other places, sure. I don't think he cares what Trump thinks because Trump wants him fired, but it's going to be a roller coaster regardless with those two. But you guys get what I'm saying here. Oh, is it starting? Wait for it. I see breaking news, but I don't see him talking. I think it's like imminent or something like that. Yeah, it's awaiting the press conference here. All I need, Michael, is for you to find me 5% on Bitcoin. What do you call it? Right now, that 5% is going to be waiting until after Jerome Powell's speech, and then probably buying up with the stop loss around, like $67,000, something like that. That's probably the move to make. It still goes back into that factor, though, that we are buying up against a massive level of resistance. So you're probably not going to be really aiming for a huge level, if you will. I mean, maybe it could be a 5x play when Bitcoin goes up 1x. That might be the best way to think about it there. I think he's going to try to do a good job, but he's just got stuck in politics. This inflation is mainly based on politics, like tariffs, etc. Everyone knows that inflation is permanent, won't go away, won't go down once it's up. Oh, yeah. I think you make it a good point there. I don't blame him necessarily for everything going up initially. I think what people probably are going to blame him for is not raising rates when he should have earlier. When he led to that inflation, like really spiking, he was like transitory. I don't believe it's his fault. I blame Democrats and Republicans. I think people just don't blame Republicans because they're usually, they yell they're more fiscally responsible. But I really blame Republicans just as much as Democrats here because, maybe not as much, but like they definitely joined forces with Democrats to pass some really crazy laws that were very, 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 very expensive. And I had a Woody call for you guys earlier, but I just totally lost where it's at. Is it right here? No. It's that one where Bitcoin... Uganda discovers gold deposits. Oh, that would send them over there. I'm trying to find this before the meeting starts here and I can't talk anymore. There you go. And I'm not sure if this is accurate, but based on how many of the trillions of dollars we're spending, if you made $500,000 per day every single day since the Great Pyramids were built, you would have less than half of what the U.S. government has borrowed since June. Should probably buy some Bitcoin. You know what I mean? Like it's that type of stuff where I'm just like, what are we doing here? However, we'll figure it out. You know, I don't have much hope in the government, but I have hope that the people of the United States can get the act together and fix it up a little bit here. I don't really got hope for the government, but I got hope for you, me, everyone watching. I'll have a good time, right? I have hope for them. Everybody else, I don't know, man. I don't know. Hey, Rick, Polkadot recovery? Oh, I bet Polkadot's been very, very good this past few days. I like Apple a lot. There's a new AI in Siri. There's a new M1 chip and killer. We'll buy a new iPhone this September for sure. Yeah, I'm going to finally buy a new iPhone here. I haven't bought one in a while, so that should be good. As far as Apple, I think it's going to be doing fine here. It hasn't been my best play over the past few, like a year or so. I haven't really been trading all too much. Maybe I'll start looking for more breakouts and things like that. I've really been going heavy on trading Microsoft as of late, and Microsoft's been a very big, juicy play. Let me show you guys this very fast. While I'm still waiting for Jerome Powell breakouts, let's go over here to, that's Meta. And so, see this? Yeah, that good. Yeah, that good buy signal way over here. It's still been going good, but every break of structure right here with the positive momentum, it's always been good. It's always been heading up for higher. You can trade these up quite a bit. So far, we have another break of structure. Everything is pointed up except for the MACD. This could also see Microsoft going even higher here, which would be fantastic. Daily chart along with it. Buying opportunities. Everything's buy, buy, buy. Boom. Break of structure right here. Everything's buy, buy, buy. Boom, boom, boom. Good, good, good. Even over here when it doesn't work out and you can kind of see like there's no resistance level way back in time over here. This is a daily chart, right? Yeah. Even when you don't have that, there's still been Fibonacci levels up here telling you to, hey, be careful with that. Be careful with that. Because even though it eventually did move up, your options would have kind of got messed up there. So just watch out for some of this stuff. But even the loss you might have sustained there, it's nothing compared to the change of character. Buy, buy, buy over here. It's nothing compared to the money you're making, which is fantastic. So maybe I'll do some more options plays with you guys over the next few weeks here as everything kind of opens up. NVIDIA has also been there quite a bit, as you guys can see. Change of character right there. Buy, buy, buy. The weekly chart's green right now, so you're not really doing many shorts. This one right here worked out pretty well. It hit a resistance level, which is where you're supposed to scale out. This one you can kind of keep on going because it is all-time highs, but again, you have to have a little bit of discipline when you go through these types of trades. We'll talk about this. You know, I'll do that for the members video. I'll make a members video actually this Sunday for everybody. I'm not here this Sunday. I'll make it this Saturday. I can't believe I'm flying out. Do so much stuff this year. So much traveling, so much fun, so many good memories. And let's get rid of this very fast. Let's come back over here. There we are. And still, Jerome Powell is not talking. This is taking a little bit more time than I wanted it to be. Oh, is the metaverse a fail by Apple? Oh, that's oh, he's on. Okay, that
unemployment is stabilized.
There's a little bit of a lag right now from what I can see, but it'll be here in a second. Basically, I see it right there. As soon as he walks out, they interrupt this guy. We'll be going live to the Senior Powell. Okay, wait for it. Come on, get out there with your binder. Chug, 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 chug. Ooh, doop, doop, doo. Come on, my man. Oh, Bitcoin coming down even more. Oh, this is a... There he is. Okay, there we go.
Go
Let's
down.
Get
the
this
public
guy
wants to see interest rates go down.
Don, we have to leave it there. Hope to see you next week at Uncharted. Here is Jay Powell.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people.
I need to get you.
Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance, with continued strong job gains and a low unemployment rate. Inflation has eased substantially from a peak of 7% to 2.7%, but is still too high. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. I'll have more to say about monetary policy after briefly reviewing economic developments.
Thanks, Multi.
Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.3% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, grew at 2.8% in the first quarter, nearly as strong as the second half of 2023.
That's good.
Growth of consumer spending has slowed from last year's robust pace, but remains solid. And investment in equipment and intangibles has picked up from its anemic pace last year. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2.0% over the next 2 years. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 218,000 jobs per month in April and May, a pace that is still strong, but a bit below that seen in the first quarter. The unemployment rate ticked up, but remains low at 4%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market have returned to about where they stood on the eve of the pandemic, relatively tight but not overheated. FOMC participants expect labor market strength to continue. The median unemployment rate projection in the SEP is 4.0% at the end of this year and 4.2% at the end of next year. Inflation has eased notably over the past 2 years, but remains above our longer-run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in April. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The Consumer Price Index, which came out this morning and tends to run higher than the PCE price index, rose 3.3% over the 12 months ending in May, and the core CPI rose 3.4%. The inflation data received earlier this year were higher than expected, though more recent monthly readings have eased somewhat. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.6% this year, 2.3% next year, and 2.0% in 2026. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5% and to continue reducing our securities holdings. As labor market tightness has eased and inflation has declined over the past year, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. The most recent inflation readings have been more favorable than earlier in the year, however, and there has been modest further progress toward our inflation objective. We'll need to see more good data to bolster our confidence that inflation is moving sustainably toward 2%. We know that reducing policy restraint too soon or too much could result in a reversal of the progress that we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SCP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate.
This is important.
Based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.1% at the end of 2025, and 3.1% at the end of 2026. But these projections are not a committee plan or any kind of a decision. As the economy evolves, assessments of the appropriate policy path will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we're prepared to maintain the current target range for the federal funds rate as long as appropriate.
We need to break above
If the
this
labor
level
market
right
were to weaken unexpectedly, or if inflation were to fall more quickly than anticipated, we're prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We'll continue to make our decisions meeting by meeting based on the totality of the data and its implications for the outlook and the balance of risks. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the long run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
We got to break through this resistance right here. Let's see.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Just wondering if you could walk me through the committee's average inflation forecast. Core PCE is now forecast to be 2.8% by the year end. It's already 2.75, and after today's number, there were several forecasts on the street that it would be 2.6 at the end of this month. Does that tell you that the average official expects no further progress in inflation, and in fact that it's going to get worse?
Yes.
And
yes.
if you have this wrong, doesn't it mean that you sort of you could have wrong the outlook for rates there?
Yeah. So what's going on there is that we had very low readings in the second half of last year, June through December, really, and we're now lapping those. So as you go through the 12-month window, a very low reading drops out and a new reading comes in. The new reading gets added to the 12-month window. So it's just a slight element of conservatism that we're assuming a certain level of incoming monthly PCE and core PCE numbers. We're assuming, a good but not great numbers. And if you put that on top of where we are now, you get a very slight increase in the 12-month reading. Now, do we have high confidence that that's right? No, it's just a kind of conservative way for forecasting things. If we were to get more readings like today's reading, then of course that wouldn't be the case. It's just a forecasting device. I think let me say that we welcome today's reading and hope for more like that.
But if it comes in, just to follow up, it comes in the way you forecast it, it would seem strange for you to be cutting rates at all in context of a rising core PCE. Thank you.
Yeah, no, I mean, I think what we said is that we don't think it'll be appropriate to reduce rates and begin to loosen policy until we have more confidence that inflation is moving back down to 2% on a sustainable basis. And that's the test we've applied. I don't know that this rules that in or out. I mean, really, it's a forecast, a fairly conservative forecast, month by month, that would lead to slightly higher 12 months rates by the end of the year. If we get, better ratings than that, then you will see that come down or remain the same. If you're at 2.6, 2.7, that's a really good place to be.
Hey, BB Fish, do you have a short on right now? Go back to 67,000.
Nick Temeros of the Wall Street Journal. Chair Powell, if I look at the rate projections, I see 15 of the 19 that are anticipating either one or two cuts this year, fairly evenly split between the two. And so I wonder if you could explain a little bit more the nuances or the differences there. Would 2 or 3 more inflation readings, like the one that we saw this morning, make a September interest rate cut possible?
So as far as the SEP part of that is concerned, as you know, I talk to all of the other participants on the FOMC every cycle, and we talk about their summary of economic projections and the their dot plot and everything. And what I hear and see is that people are looking at a range of plausible outcomes, and in many cases they're thinking, I can't really distinguish between two of these. They're so close for me. These are very close calls. But we ask them to write down the most likely one, so they do. And I think as you've said, there's 15 of the 19 are kind of clustered around 1 or 2. So I think I would look at all. I look at all of them as plausible, but I look at I think that does tell you kind of what the committee thinks. But what everyone agrees on is it's going to be data dependent. No one brings to this or takes away from it, that is on the committee, a really strong commitment to a particular rate path. It's actually just their forecast, and it's a combination of their forecast and their own reaction function. But again, everyone would say that this is very data dependent, and I don't hold it with high confidence. And I think if you're
the
looking
lack of
for
confidence this guy has right now is crazy.
Don't really think that they're not trying to send a strong signal that this is what I think is the right thing. It's just what they think at a given moment in time, subject to data. In terms of future meetings, we haven't, we don't make decisions about future meetings until we get there. I think in terms of what we need to see, I mentioned it earlier, we want to gain further confidence. Certainly more good inflation readings will help with that. I'm not going to be specific about how many, because really it's going to be not just the inflation readings, it's going to be the totality of the data. What's happening in the labor market, what's happening with the balance of risks, what's happening with the forecast, what's happening with growth. You look at all of that and you ask, are we confident? Have we reached an appropriate level of confidence that inflation is moving down sustainably to 2%? Or alternatively, do we see really unexpected signs of weakness in the labor market that would call for a response? Which is another thing that could happen. But again, we don't see that. And we see today's report as progress and as building confidence, but we don't see ourselves as having the confidence that would warrant beginning to loosen policy at this time.
And if I could quickly follow up, did you or any of your colleagues change your interest rate projections after 8:30 or whenever you got the inflation numbers today?
So this happens too often, but it does happen. It just is, data came, I think it happened a few meetings ago. So when that happens, when there's an important data print during the meeting, first day or second day, what we do is we make sure people remember that they have the ability to update. We tell them how to do that. And some people do, some people don't, most people don't. And I'm not going to get into the specifics, but you have the ability to do that so that what's in the SEP actually does reflect the data that we got today, to the extent you can, reflect it in one day.
He just said most people don't.
We'll see PPI tomorrow. We'll know more about the PCE reading as the month goes on, but the initial CPI reading, and it's kind of first level translation to PCE. We did have this morning. We were briefed about it, and people were able to consider whether they should make changes. And as I said, some people generally do, but most people generally don't.
He said nothing but so much at the same time.
Hi, Chair Powell. Janelle Marte from Bloomberg. As you noted, the labor market is now in many ways back to where it was before the pandemic. I wondered if you could comment on how officials are viewing that. So do you think that there still needs to be more cooling in the labor market to bring inflation all the way down to 2%? Or is there any sense that maybe the labor market is more vulnerable now to higher rates now that many of those imbalances have eased?
Sure. So by so many measures, the labor market was kind of overheated 2 years ago. And we've seen it gradually move back into much better balance between supply and demand. So what have we seen? We've seen labor force supply come up quite a bit through immigration and through recovering participation. That's ongoing mostly now through the immigration channel, but still we've had some increases in prime age labor force. In terms of on the demand side, we've seen quits moving down. We've seen job openings moving down. We've seen wage increases moving from very, very high levels a couple of years ago back down to more sustainable levels. We have seen unemployment creep up now 0.6 over the course of a year or so, very, very gradually. So you put all that together, what you have is still low unemployment, still 4% unemployment, historically low. But it's moved up a little bit. It's softened a bit, and that's an important statistic. But more than that, you've got strong job creation. You have payroll jobs still coming in strong, even though there's an argument that they may be a bit overstated, but still they're strong. So that's what we see. We watch the labor market, of course, and the economy as a whole, but the labor market very carefully, and that's what we see. We see gradual cooling, gradual moving toward better balance. We're monitoring it carefully for signs of something more than that, but we really don't see that.
As a quick follow-up, the surveys that make up the jobs report are showing different tales. There's been some divergence, especially we saw in the last report that we got on Friday. So how do you interpret that, and how does it change your view on the labor market?
So sometimes you can't reconcile the differences. You just have to look at it and try to understand. And that's why it always makes sense to look at a series, in 3, 6, and 12 months of things rather than just one report. But you're right to point to the last report where there were job losses in the household survey, job gains, big job gains in the establishment survey. So, we're left with ambiguous results, and we have to deal with that uncertainty around data. Nonetheless, the overall picture is one of a strong and gradually cooling, gradually rebalancing labor market. Job openings, while they've come way down, are still, greater than the number of unemployed people. The jobs workers gap is still a significantly positive number, greater than it was before the pandemic. So overall, we're looking at what is still a very strong labor market, but not the superheated labor market of 2 years ago or even 1 year ago.
Thanks, Chair Powell. Neil Irwin with Axios. Back on the rates path, the SEP showed quite large shift of rate cut expectations relative to March. That's a period in which the economic data flow hasn't been that dramatic a shift. How can you provide some color on what changed in attitudes on the committee over the last 3 months to see a much shallower path of rate cuts this year?
Yeah, the big thing that changed was the inflation forecast. So the inflation forecast moved up several tenths for the end of the year. And as I mentioned earlier in the what did we take away from this? We had really, really good inflation data in the second half of last year, then kind of a pause in progress in the first quarter. And what we took away from that was that it's probably going to take longer to get the confidence that we need to begin to loosen policy. So the sense of that is that rate cuts that might have taken place this year take place next year. There are fewer rate cuts in the median this year, but there's one more next year. So if you look at year-end 2025 and 26, you're almost exactly where you would have been. Just it's moved later because of that progress. Now you get different data today. So we'll have to see where the data light the way.
Let the data light the way.
The economy has repeatedly surprised forecasters in both directions, and today was certainly a better inflation report than almost anybody expected. And we'll just have to see what the incoming data flow brings and how that affects the outlook and the balance of risks.
Gina Smiley, New York Times. Thanks for taking our questions. In the summary of economic projections, the long-run interest rate forecast moved up a bit. I wonder if we should read that as a sign that you think that policy is not sort of as restrictive as we previously expected. How should we interpret what that means about how the committee views its current policy setting?
So two things about that. One is this. You're right, it did move up, but I want to remember to point out that long-run neutral rate of interest is a long-run concept. It really is a theoretical concept, can't be directly observed, and what it is the interest rate that would hold the economy at equilibrium, maximum employment, and price stability, potentially years in the future where there are no shocks. So it's a little bit, it's not something we observe today. Today we've got a very specific economy with all kinds of shocks we're still getting over from the pandemic. So it's I don't think that the concept of R-star, it's a very important concept in economics and in what we do, but honestly, it doesn't really get you where you need to be to think about what appropriate policy is in the near term. But back to your original question, people have been gradually writing it up because I just think people are coming to the view that rates are less likely to go down to their pre-pandemic levels, which were very low by recent history measures. Now, we can't really know that. That's an interesting dispute and discussion to have now, but ultimately we think that things like the neutral rate are driven by longer run, slow-moving forces, and there's a really good question about whether those really have changed or whether instead rates and the economy are experiencing a series of persistent but ultimately temporary shocks. That's been the debate.
Here's the 1 hour chart.
And we can't know. But in the meantime, we're making policy with the economy that we have, with the distortions that we have. And I also, to your other point, I think it is the case that as time has gone by, the question of how restrictive is policy has become one that everyone's asking, and we're asking it too. And my answer has been that policy is restrictive. The question of whether it's sufficiently restrictive is going to be one we know over time. But I think for the reasons I talked about at the last press conference and other places, I think the evidence is pretty clear that policy is restrictive and is having the effects that we would hope for.
Well, thanks, Chair Powell. Howard Schneider with Reuters. Just to carry that a little further, should we read this as a conclusion that the combination of tipping to one cut this year and acknowledging further progress on inflation as kind of a mark to market on the level of restrictiveness that you need, that you in fact have concluded that you weren't quite there yet?
I'd be reluctant to try to draw that conclusion. I think this is about looking at the incoming data and asking how much progress are we making on inflation and how is the rest of the economy doing? Is the labor market still strong? That's what we're thinking about. You can translate it into the language you're talking about, but to me the focus is more on we have a goal which is price stability, another goal which is maximum employment. How are we doing there? We think we've got a good, strong labor market still. We think we've been making progress toward the price stability goal. And then for a while there was a pause, and we look at today's thing and we think, well, that's a good reading, and we hope we get more like that. And in the meantime, we're asking, is our policy stance about right? And we think yes, it's about right. We're prepared to adjust it as appropriate, but we think we're getting the things that we would want to get, broadly speaking. And that's why we've been at this policy right now for almost a year.
So just to follow up on that, I think what curious thing here is you've got now this restrictive policy in place and virtually no change in any of the major things for all of this year. You've got growth that stays above long-run potential throughout the forecast period, unemployment that never goes above the long-run estimate, right, of 4.2. So this isn't a story of slack improving inflation. So where's the improvement in inflation coming from that it's going to pick up pace so much in 2025?
Well, it's been coming. Where's it been coming from? We'll start with that. Clearly, a lot of some of what we've been getting is just the reversal of the unwinding of the pandemic-related distortions to both supply and demand, and that is complemented by and amplified, supported by restrictive monetary policy. So those two things have been working together. We've also had a very positive supply shock on the labor side, and also you get a positive supply shock when the supply conditions unwind and return to normal. So you've had above trend potential growth and high growth, and yet you've had the benefit of inflation coming down really fast actually last year, and we'll see what the rest of this year brings. So these dynamics can continue as long as they continue. Ultimately the question is are you down to demand? And we don't know that though. We're look at today's report. If we see more like that, we can't know what the future holds. But in the meantime, we've made pretty good progress on inflation with our current stance.
Michael McKee from Bloomberg Radio and Television. The base case of the committee seems to be that there is going to be at least one rate cut this year, but your growth forecast doesn't see any slowdown in the rest of the year, nor does the unemployment forecast see any significant weakening of the labor market. And your inflation forecasts basically average out to no change. So if at the end of the year there is no change from conditions now, why would you anticipate cutting rates? What would be the point for a rate cut?
Well, we think policy is restrictive, and we think ultimately that if you just set policy at a restrictive level, eventually you will see real weakening in the economy. So that's always been the thought, is that since we raised rates this far, we've always been pointing to cuts at a certain point, not to eliminate the possibility of hikes, but no one has that as their base case. So no one on the committee does. But so that's how we think about it, and that's what we've been getting. That's what we've been getting is good progress on inflation, with growth at a good level, and with a strong labor market. Now, ultimately, we think rates will have to come down to continue to support that, but so far they haven't had to, and that's why we were watching so carefully for signs of weakness. We don't really see that. We kind of see what we wanted to see, which was gradual cooling in demand, gradual rebalancing in the labor market, while we're continuing to make progress on inflation. So we're getting good results here.
Well, to follow up, is there any kind of concern for the housing industry or financial stability, banks, in leaving rates where they are for too long at this point?
Yeah.
On housing, the housing situation is a complicated one, and you can see that's a place where rates are really having a significant effect. Ultimately, the best thing we can do for the housing market is to bring inflation down so that we can bring rates down so that the housing market can continue to normalize. There will still be a national housing shortage, as there was before the pandemic. There will still be one, but the distortions that we see now with lock-ins and things like that, low mortgages. In terms of banks, the banking system has been, solid, strong, well-capitalized, lending. We've seen good performance by the banks. We had the turmoil early last year, but banks have been focusing on bringing up their liquidity, bringing up their capital, and having a risk management plans in place. So the banking system, seems to be in good shape.
I would say okay shape.
Thanks, Chris Rugaber at Associated Press. I was wondering if we can, on inflation, if you can tell us a little more about where you see inflationary pressure in the economy. You mentioned labor markets coming into better balance, and inflation expectations appear to be well anchored. You're seeing, anecdotal stories of the large chains like Walmart and Target are announcing price cuts. McDonald's announcing a $5 meal deal. So, people may still be unhappy about prices at the grocery store, but it doesn't seem like there's a lot of inflationary pressure left in this economy. I wonder if you could tell us more about it.
I think it's true that inflationary pressures have come down, but we're still getting high inflation readings. So, and I think you can see it in various places. In some parts of non-housing services, you see elevated inflation still, and that's probably it could be to do with wages. Goods prices have kind of fluctuated. There's been a surprising increase in import prices on goods, which is kind of hard to understand. And we've taken some signal from that, but and of course, housing services, you're continuing to see high readings there. To some extent, that's catch-up inflation from earlier pressures. But I mean, overall, you're right. Inflationary pressures have come down. As I mentioned, the labor market has come into better balance. Wages are still running, I would say, above a sustainable path, which would be that of trend inflation and trend productivity. You're still seeing wage increases moving above that. We haven't thought of wages as being the principal, cause of inflation, but at the same time, getting back to 2% inflation is likely to require return to a more sustainable level, which is somewhat below the current level of increases in the aggregate.
Rachel. Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. There's obviously a lot of focus on how many cuts could be expected this year, but can you give us a sense of what one cut by the end of the year would actually do to the economy, what you think would be a meaningful difference if there was a cut by the end of the year, or even two?
I like this one.
I think if you look back in 5 or 10 years and try to pull out the significance to the U.S. economy of one 25 basis point rate cut, you'd have quite a job on your hands. So that's not how we look at it. Really the whole rate path matters, and I do continue to think that when we do start to loosen policy, that will show up in a significant loosening in financial market conditions, and the market will price in what it prices in. I have no way of saying we're not at that stage, so I don't know what we'll be thinking about at that time, but it's a consequential decision for the economy, and you want to get it right. And fortunately, we have a strong economy, and we have the ability to approach this question carefully, and we will approach it carefully while we're very much keeping an eye on downside economic risks should they emerge.
And you've been talking about this clear sense that it's just going to take longer to have the confidence that's needed for rate cuts. Is there something about what happened in the first couple of months of the year that you're seeing differently now with more time or hindsight? Do you still characterize it as expected bumpiness or something more lasting that is affecting your policy for the rest of the year?
We always want to avoid the tendency to dismiss the parts of inflation that we don't like and just make it go away. But we had a quarter where inflation was running higher, and yes, I could stand here and say, it's stuff we shouldn't have taken signal from, but it is what it is. You have to, low inflation is low inflation, high inflation. So if you have a quarter where it's higher, we tried not to take signal from the first couple of months, but we got a third month and we said, okay, the signal we're taking is that, we think it's going to take longer to get confidence that inflation is moving sustainably on 2%. That's what we said. I think that was the right thing to do. I still think that's the right thing to do. Now we have today's inflation reading, which is very different, very much more positive. We're going to have to see what the trend is, what's going to be the data going forward. We're looking for something that gives us confidence that inflation is moving sustainably down to 2%. And readings like today's, that's a step in the right direction. But one reading isn't. It's only one reading. You don't want to be too motivated by any single data point.
Jolene.
Hi, Chair Powell. Thank you for taking our questions. I'm Jolene Kent with CBS News. What's your message to Americans who are seeing encouraging economic data but don't feel good about this economy?
Reasonable.
I don't think anyone knows has a definitive answer why people are not as happy about the economy as they might be, and we don't tell people how they should think or feel about the economy. That's not our
prices.
job. People experience what they experience. All I can tell you is what the data show, which is we've got an economy that's growing at a solid pace. We've got a very strong labor market with unemployment at 4%. It's been a long time since we've had a long stretch of time with unemployment at or below 4%. Very long time. We had a period of high inflation. Inflation has come down really significantly, and we're doing everything we can to bring that inflationary episode fully to a halt and fully restore price stability. We're confident that we'll get there. And in the meantime, it's going to be painful for people, but the ultimate pain would be a long period of high inflation. It is people who lower income people, people at the margins of the economy who have the worst experience, who experience the most pain from inflation. So, it's for those people, for all Americans, but particularly for those people that we're doing everything we can to bring inflation back down under control.
As just a quick follow-up here.
Oh no, what happened?
You've indicated one interest rate cut sometime this year, and I know you don't have a crystal ball up there, but a lot of people are watching and see, borrowing money remains very expensive. For everybody who's out there waiting on a rate cut, about when can consumers expect some relief?
I like the way she phrased it.
Well, I don't have a precise date for you, but what we said is that we want to make sure that we're confident that inflation is actually moving back down to 2%. And when we are, then we can look at loosening policy. So having that kind of confidence that inflation will be at 2%, it just pays benefits to the whole economy, to all Americans for a long period of time. We had that period for a very long time. We very much want to get back to a place where people can not think about inflation. It's just not a concern in the everyday economic decisions that they make. We were there for a long time, and our goal is to get back to that place. And we've made good progress, and we're in the phase now of just sticking with it until we get it done.
My bad. My mic's not low. It's just that the audio is so much louder.
In the statement on there being modest further progress on inflation. Halfway, through the year and after today's CPI release, what have you and other committee members found that has been particularly encouraging to you? And just in terms of the conservatism, how much of that is about stickiness in shelter inflation in particular? Thank you.
So encouraging has been that growth, the growth clearly that we had last year, and particularly the second half of last year, and we continue to see still strong growth, or solid growth this year. That's been very encouraging. If you go back a year, there was a real concern about, very much slowing growth and a recession. Many forecasters had that. And that's not what happened. Instead, the U.S. is, anyway, and it's in sharp distinction with many other advanced economies around the world. So that's been encouraging. I would say that today's inflation report is encouraging, but it comes after, several your reports that were not so encouraging. You ask about, your second question was really about shelter inflation. So I think if you go back a couple of years, we know that there are renters, and then there are people who own their houses, and we have OER, which is owner's equivalent rent. And so when market-based rents go up sharply, as they did at the beginning of when the economy reopened, they really went up sharply. Those play into rollover rents much more slowly for existing tenants than they do for new tenants. And so we found now that there are big lags. So there's sort of a bulge of high past increases in market rents that has to get worked off, and that may take several years. Nonetheless, as long as market rents are going up at relatively low levels, and they still are, this is just going to happen. It's just going to happen more slowly than we thought. We also do sort of this thing where we impute a rental value to owned homes, and that's many countries around the world do that. Some do it differently than us. It's something that the price experts have regularly looked at. It is not something that we're the only country that does, and it's not something we're looking at changing or would look at changing, anytime soon. But it's true. It's one of the very hardest things in inflation and in prices is how to think about, the services that someone is getting by living in a home that they could rent, but they're actually living in it. And some countries should just ignore that, but that's not how we do inflation here. We do it the way we do it, and we've been very transparent about it. And it's true that we're seeing delays in realizing what's happening economically, but we understand that. We understand that very well.
Edward.
Edward Lawrence with Fox Business. Thank you for taking the question, Chair Powell. So I want to go back to jobs and the consumer. The last jobs report showed that over the past year, 634,000 more people took multiple jobs. That's up 8.2%. And since January of 2021, we've seen prices rise 19%. So people are using their credit cards to pay for their lifestyle. What pressure points will signal to you that the slowing economy could maybe break companies in terms of hiring or break the consumer in terms of spending?
So, we monitor all the things you mentioned and more. What we're seeing is basically spending was going up faster than disposable income during big parts of last year rather. And so what that you'd expect to see is people spending more on their credit cards. That has been happening. Credit card balances have been going up. Credit card defaults have been going up. They're not at high levels. Remember that after the pandemic, people were cooped up. They couldn't spend money. They couldn't go out to spend money. They could spend money from home. But households were in very, very strong, historically strong financial shape. They've now worked off a lot of that. So we're watching that carefully. And, what do we see? That's what we see. We see the same data that everybody else sees, but you've still got household sector that's in pretty good shape. But nonetheless, it's not in the kind of shape it was in a year or two ago. And we're carefully watching that.
So how close then are we to that point where the consumer can't continue to spend as it's spending, or companies can't hire like they're hiring?
Consumer spending is still growing. It's not growing at the pace it was growing at a year or so ago, but it's still growing solidly. And by the way, other parts of the economy are picking up. Spending on equipment and intangibles has picked up quite a bit in the wake of all the construction that we saw of new tech plants. So overall, the economy is exhibiting solid growth, and something around 2%, which is a good pace of growth for the U.S. economy. But you're right, though. We do see the same thing other people see, which is increasing financial pressures on more lower income people, and the best thing we can do is to foster a very strong jobs economy, which we think we have done. Ultimately, to get inflation under control, because those people experience inflation, very directly, very painfully, and once we get inflation under control, rates can come down, which will also improve things.
Victoria.
If you guys haven't already hit the
Hi, Victoria Guida with Politico. You've mentioned that an unexpected weakening in the labor market would bring rate cuts sooner, and I was just wondering, can you talk a little bit about what that would look like? Is it more of like a quicker pace of people losing jobs? Is it more the level of the unemployment rate if it were to start to go above 4.2 or something like that? How are you thinking about what you're looking for to see the job market unexpectedly weaken?
When I say unexpectedly, the first thing is more than kind of is in our forecast or in common forecasts. So something more than that. But we'll be looking at everything. The labor market, has the ability, has the tendency sometimes to move to weaken quickly. So waiting for that to happen is not what we're doing. We're watching very carefully. We're looking at the balance of risks. I always point out the balance of risks. So and also the fact that we look at all of the whole situation. So a decision to begin to loosen policy could have several reasons associated with it at a given time. But I would just tell we monitor all the labor market data, and if we saw troubling weakening more than expected, then that would be something we'd consider responding to. But we look at the broader context of what's going on too.
So something like negative payroll numbers would be.
I'm not going to. I can think of things many things would make it on that list, but I don't think I'll butter them here.
I like how they do that laugh, like,
Thank you, Chair Powell. Simon Urbanovich with The Economist. May I ask, you mentioned with the slightly higher PC readings earlier this year that it wasn't 1 or 2 months, but 3 months that tipped you to be a bit more cautious in the rate outlook. Should we take from that it looks like May will be quite good for PC as it was for CPI? Does that imply that kind of 2 more good months would reinstill the confidence that rate cuts could be coming sooner than you currently project?
You know, I don't actually have that kind of mechanical thing in my thinking. I get that, you know, as many good ones as we had bad ones, but no, it's not like that. It's the whole, it's going to be the totality of the data.
That's
The
not
labor
what he
market
said
data,
a few
the
months
growth data. In terms of inflation, you know, you'd want to see real progress that builds your confidence that we are on a path down to 2%. And I don't want to try to give you specific numbers of things because that points to dates, and I just don't think we're not at a point of being able to do that.
Hey, we got a little bit of breaking a higher high, or we broke a lower high.
Thank you for doing this. I'm Kosuke Takami with Nikkei. I would like to know about the impact of stronger dollar on.
Excuse me, test. Oh, my mic is a little bit low. I don't know why.
So markets should determine the exchange rate, but Japan and some emerging markets are suffering from the strong dollar. So I want to know if it is having a positive impact on U.S. economy in total. Thank you.
So we don't. Actually, it's our finance ministry, the Treasury Department, that has a responsibility for thinking about and if it sees fit, doing things about the level of the dollar. So for us, it's just another financial variable. And you're right, the dollar has been has exhibited some strength over the course of the last year or so because the U.S. economy is very strong. We don't think of it as benefiting or hurting the U.S. We don't manage the level of the dollar. That's not our job. It's not. And for our economy, what we're trying to foster is maximum employment and price stability, and we feel like we've made good progress on both of those goals over the course of the past year.
Jennifer. Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said you would cut rates before inflation falls to 2%. You're forecasting inflation to end the year at 2.8% on core PCE, or at 2.8%, of course, on core PCE. Right now, you said the inflation forecast is conservative and that if you got 2.6 to 2.7 on PCE, that would be a good place to be. You also indicated the job market has mostly normalized. So why not cut rates this summer just once? You're well above neutral, to try to preserve the soft landing rather than risking waiting too long in the quest for confidence for inflation.
So we're well aware of the two-sided risks here. Let me just say we understand that if we wait too long, that could come at the cost of economic activity, of employment, of the expansion. We understand that if we move too quickly, we could end up undoing a lot of the good that we've done and have to then start over, and it could be very disruptive. So we're extremely aware of both of those risks and just basically trying to manage them. And what we said is that we don't think it'll be appropriate to.
No, what the heck's going on with my stuff? Don't make me refresh
to begin to loosen policy until we're more confident that inflation is moving down to 2% over time on a sustainable basis. That's kind of been our test. Or there's another test, which is an unexpected deterioration in labor market conditions. So I think that's the right way for us to think about it. That's our dual mandate there, and we have a strong economy. We've got growth. All forecasts are very commonly around 2%. That's a strong growth rate for our economy. The labor market continues to print jobs at a pretty high rate. Unemployment's still low, so we have the ability now to approach this question carefully, and that's what we're doing.
Just to follow Chair Powell, do you need to be ahead of a weakening in the labor market? Otherwise, is it too late, given that the labor market is a lagging indicator, right, when you look at the monthly jobs data?
Yeah, we completely understand that that's the risk, and that's not our plan, is to wait for things to break and then try to fix them.
That's exactly what you just said.
We're trying to balance these two goals in a way that is consistent with our framework, and we think we're doing that.
Evan.
That got him ready to pack up and go.
Thank you, Chair Powell. Evan Reiser with Market News International. You have mentioned before the framework review process will start in the latter half of the year. At this point, do you have any specific time frame for the start of that? Who will lead it? Will it be you or a committee group of your peers? What will be the parameters? Do you anticipate the review will consider changes to communications going forward?
Smash that
So
like button, please.
what we've been thinking is that we would announce and commence the review later or late in the year. In the
going up.
meantime, as that time approaches, we will be devoting a lot of careful thought and planning to the contours of it. Within scope would certainly be communications generally. I'm not going to say that we'll look at this or that particular thing. And all the other details, we don't want to get prematurely into a conversation until it's really time to have it. And so, I'm going to leave pretty much everything else to later in the year.
Go to Nancy for the last question.
Last question, everybody. Last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Just one more question on housing. Can you still cut rates with shelter prices high, or will you wait until they start to moderate a bit?
Oh, good question.
I wouldn't. There isn't any one thing, one variable like housing prices moderating that would really decide against what we're doing. We've got an overall test, which is greater confidence that inflation is moving down to 2% on a sustainable basis. That's our overall test. Or alternatively, we see unexpected weakening in the labor market. So those are two different tests. I would say, we're not looking at any one price in any one sector and saying that's the one. We don't target housing prices, for example, and we don't target wages. We target aggregate prices and overall employment. So.
But if housing prices remain sticky, could that slow down the pace of rate cuts?
I think you'd look at we'd be looking at the aggregate numbers and asking ourselves what's going on here with inflation at the aggregate level. And of course, if any price that contributed to ongoing inflation would matter. Any price that contributed to ongoing disinflation would matter too. But I wouldn't single out housing as having a special role there. Thank you very much.
Okay, that was it for Jerome Powell. Let me explain basically what he just said, and then we can talk about the overall gist. So he was much more hawkish than I thought today, much more hawkish. After every time of having bad CPI data, he was so dovish, right? Very dovish, very dovish. He was not dovish today, which kind of sucked. You saw what happened to the market here over the past couple hours. Coming up from that high CPI over here, dumping back down after Jerome Powell says no rate cuts happening right now, and that's okay. So to kind of summarize a lot of this stuff, the Federal Reserve, they are gearing up for at least one rate cut this year. If we have one or two more good CPI reports, it should go up towards 2. I think 2 is the max we're going to see, unless something drastic happens, of course, and then things have to get a little bit nastier. But more realistically, we're going to be looking at 2 rate cuts. They seem at this point in time to be around September and November. Those are going to be the 2 dates that you guys are going to be looking for. I think I can find over here, I think it's, was it Jerome's or was it somebody else's? There you go. Before the CPI data came out today, this was the percentage chance for having cuts. The way this is this is the current rate right here, 5.25 to 5.5. That's the current rate. People expect this 99.4% to stay the same today. Well, guess what? It stayed the same. In July 31st, we expect it to stay the same again. However, in September, and this is before we got the good data in today, everybody was expecting half of the people were expecting us to have a one rate cut of down 0.25 basis points, 25 basis points, excuse me. And the other half basically said, hey, we're not going to have a rate cut in September. And then if you went over to November, then that started to shift a little bit more. We started to see 17% say, hey, we were going to have 2 rate cuts by then, and we were going to be at 4.75 to 5.0 as far as the interest rates, 5.0 to 5.25. 48% said we were going to be there, and then only 33% said we were still going to have no rate cuts whatsoever. And of course, as December comes along, you can see how all of that changes even more, coming into 2025 and so forth, how that kind of shifts. And again, we're still at the halfway point of 2024. We have a long way to go, but if you ask me right now, off of that good report and hopefully more down the road, that hopefully is a big thing here. We need to have more than just one. We're probably looking at our first rate cut happening in September, our second one happening in November. If we have bad data a few times before that, it'll most likely get pushed back till November, and everybody will be very, very mad about that, sad about that. You see Bitcoin coming down and so forth. But with the move that Bitcoin's been able to make over the past few days, you can see we're still kind of going sideways overall. We're still up today, which is a very nice move. We're getting rejected off of the 20-day moving average. Nothing necessarily crazy, but that's still what's happening. What we're hoping for here is that general trend, chug, 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 and having a breakout since we did have the good CPI news. The stock market is doing fantastic at this point. You can't even see because it's kind of neutral at this point. You can see the gap up with the SPY. See that gap right there? NASDAQ gapped up as well, still moving higher, and the Dow Jones is just kind of do what the Dow Jones does and it goes sideways. It has not been pumping up as much. It's just not that tech heavy, unfortunately for us, but that's okay. Dollar index still coming down a lot. We need this to keep on coming down more and more and more, and over the next few weeks, I expect us to be breaking down below the support level, giving Bitcoin the opportunity to go much higher to 80,000, 85,000. You guys know what I'm talking about here. That's the big thing. I'll tell you something, September fish. Oh yeah, what do you call? We all want to see this have a big move here. Let's see right here. I see we still have high rates in 2027. I hope not. I'm not even going to be living in America in 2027. You got to be kidding me for that one. There's definitely some crazy times ahead for the U.S. and the dollar index and all that type of stuff. You know, even as Bitcoin continues to go lower just by a little bit here, you're definitely going to be just, you know, patiently waiting for all this to happen. If you guys are looking to get bullish on Bitcoin, we need to break this system of higher lows in the 5-minute chart, the 15-minute chart. And at this point, that resistance level is up around 69,420, a little bit out of reach, but not impossible. I'm looking at a bunch of altcoins right now, and they're still at 5, 6, 7, 10+%. I'm still going to be dollar cost averaging these. But again, like I said before, this is not a time, in my opinion, to start doing a lot more swing trading. I am definitely going to be doing a lot more day trading. And then on top of that, when I'm not day trading, I'll be dollar cost averaging, putting more capital into the markets, letting that capital work for me, and then just waiting for this cycle to give me some money here. And we'll see how that goes, right? So I still think there's going to be good times ahead, but just be careful if you guys are not used to trading in this volatility. Just literally wait until tomorrow morning or give it like 5-6 hours. The market will stabilize a little bit. It'll give you a pattern, and whatever way that pattern breaks out, it's going to be a really large move to that side. So even if it's a downward side, it will still come back down to support, bounce off of it, etc. Okay, so I'll see you guys a little bit later. I am not going to stream tonight because I've already done 2 streams here, and I'm very, very tired. I was resting on my bed earlier today, and Loki threw up on my bed. So I'm still in the process of cleaning that up with bleach and shit. So yeah, all my blankets are literally in the washing machine right now, or in batches because you don't want to wash all of them at the same time. But what do you call it? Yeah, so it's definitely a process here, guys. Definitely a process. I'll give you guys a video probably later on tonight. Loki says goodbye, and you guys can chill in the Dogecoin stream if you guys want to. Loki, come here. Up. Oh, look at you being a good boy. There you go. And if you guys haven't, please make sure to subscribe and like the channel. I'm going to tell you guys from now on, always to spam the chat. I don't care what you guys are talking about, but YouTube seems to love when you guys are engaging in the stream and not just staying quiet. Because usually when you guys stay quiet, I'm just going to start ending the streams early because then nobody wants to engage. It's kind of a very awkward thing for me to do. So hopefully, guys, you guys all have a good rest of your day. Thanks.